Views expressed are solely those of the speakers and do not represent this show or its team.
People keep doing the same thing over and over and over again until it really bites them hard. It takes a crisis to change somebody's mindset. I think it's going to take a real reset of expectations from some massive market move to shake people from this idea that they're getting entrenched in, which is inflation is a problem. I need to act as though inflation is a problem.
Welcome to Built to Last, conversations about wealth, work, and life. I'm Wade Lopez, and I'm joined by our Chief Investment Officer, Gary Aiken. Today, we're going to be talking about something that I believe is quietly reshaping every part of the economy. I'm calling it the death of easy money. For well over a decade, we operated in an environment of near zero interest rates, cheap capital, massive liquidity, and easy access to financing. That environment impacted everything: stock valuations, real estate, business growth, investor behavior, and even how companies were managed. Here's what I think is getting overlooked. An entire generation of investors and business owners have never really operated in a sustained higher rate environment. This is not a temporary adjustment for many of them. This is an entirely new experience. So today, it's not about predicting the future or making wild claims. It's about helping people think clearly about what this shift actually means for investors, for business owners, and the broader economy moving forward. Gary, let's start with the big question. Do you believe the era of easy money is actually over? And if it is, how significant is that?
Hey, Wade, good to see you again. The era of easy money definitely ended in March of 2020 when the 30-year bond reached 0.98%. And I think it's a significant item that all business owners and investors need to consider going forward.
Yeah, I would agree. And before we talk about what comes next, I want to make sure our audience understands what actually created this environment in the first place. A lot of people lived through it without fully understanding the machinery behind it. What exactly created the money era? Was it primarily Federal Reserve policy, government spending, globalization, or was it all of the above?
So I think it's a combination of technology getting better, globalization forcing costs down or slowing the rate of inflation. And then finally, the Federal Reserve reacting to every crisis by printing more money to solve the crisis. Those three things together created an era of easy money from, say, 1982, and then really starting to ramp up in the 2000s. To the pandemic in 2020, where it all came crashing down.
Do you think the markets became so deeply dependent on cheap capital then?
I don't think the markets became dependent on cheap capital, but certainly in different times we have become dependent on cheap capital. I mean, the financial crisis in 2008, 2009 was a direct result of cheap capital going to people who didn't deserve cheap capital. And we've had those issues before. And certainly, we can trace, each financial panic or each financial crisis that we've had to money being too cheap, too available to people who don't have good uses for it. But I don't think that markets are necessarily dependent on cheap capital for growth.
Okay. Do you think most people genuinely underestimated how abnormal the last 15 years actually were?
Yeah, I think so. I was actually thinking about that this morning, driving into the office, listening to Bloomberg Radio and talking about inflation and where it is today, that inflation is around 3%, maybe 3.2%. And it got me thinking, long run inflation has been about 3%. So if anything was abnormal, it was an era where interest rates were zero and inflation was sub 2%. That was probably the abnormal period.
Do you think that's more structural than temporary? Or do you believe we're still working through a post-pandemic distortion of interest rates?
I think in the post-pandemic world that we are going to have interest rates be structurally higher, that we are purposefully, both we and other countries are purposefully reducing globalization in favor of nearshoring and onshoring. That is making trade more difficult. Certainly the wars in Iran and Ukraine are making transit of goods and services more difficult and more costly around the world. And then finally, the Federal Reserve and other central banks are fighting inflation greater than they did the previous 20 years. And so interest rates are going to be higher. So I think that, structurally speaking, we are in a different place than we were, pre-pandemic.
What role is the government debt? Thinking about rates, where do they go from here?
Generally, I think that long-term rates are likely to go up over the medium term and long term. We are certainly going to be printing a lot more money to deal with expanding deficits that are mostly the result of Social Security and Medicare spending in the U.S. So, if we can't find buyers at the current price for government debt in the future, then the price has to go up, and the price is quoted in interest rates, and interest rates are therefore likely to go up more than they're likely to go down.
Yeah. Does the Federal Reserve realistically have the same flexibility it once had, or has that changed now?
The Federal Reserve still has its independence and can still work around the edges. And of course, the Federal Reserve mostly deals with short-term interest rates. It's only a near-term phenomenon that the Fed, tried to impact other parts of the yield curve, buying other instruments other than T-bills. If anything, I think the Warsh Fed will probably return to using T-bills mostly to affect government policy, and being less experimental with buying mortgage-backed securities or longer-dated treasuries, or trying to rescue markets.
Do you think we're entering a period where interest rates remain structurally higher for longer, not just temporarily elevated, or where do you think that kind of folds out?
So I think what I would characterize as structurally higher is we're going back to this idea that, when we look at interest rates, it ought to be comprised of a real rate of return plus an inflation expectation. And so therefore, if we think that growth is going to be 2% and inflation is going to be 3%, then interest rates ought to be somewhere around 5%. And guess what? The 10-year Treasury, got to 4.6%. So sort of right in line with that idea. And so we're getting closer to what was normal before the era of 0% interest rates and abnormally low inflation. We're getting back to normal. And I think that is going to seem structurally higher to people like you talked about, who had readjusted what they thought was normal to 0%. But it's not going to be abnormal for people who remember life before that.
I agree. And the one thing that we've noticed, me personally, is the businesses I operate, that easy money can kind of hide a lot of problems, right? When capital is cheap and liquidity is abundant, mistakes are survivable. Weak business models keep their doors open. Average operators look like great ones, but when borrowing costs rise and liquidity tightens, the picture changes quickly. I think discipline starts to matter again in a way that it has not mattered for a long time. And I also think about this inside our own firm, right? How we think about debt, how we manage cash flow, how we evaluate new opportunities. The calculus is generally different in this environment than it was 3 or 4 years ago. And I think business owners who've not updated that calculus are certainly feeling it, or they're going to feel it. So Gary, moving back toward fundamentals, is this shift deeper than just a simple return to basics in your mind?
I don't think it's deeper than a return to basics. I think it's exactly a return to basics. And And so as long as we keep our heads around that and we don't think or calculate a scenario where we go back to 0%, and we also sort of fade the fear that interest rates are going to 8% or 10%. I think as long as we sort of say, look, we're going to be kind of range bound here between 4% and say 6% on the 10-year Treasury, and between call it 3% and 5% in Fed funds, that we can plan for that. There's nothing wrong with planning in an environment like that. And markets have gone up in an environment like that before, and businesses have been able to implement their game plan. So I don't think it's really that big of a deal. I think the biggest deal was making sure to get it right out of the transition from 0% back up to something quote unquote normal.
Yeah, well, you mentioned businesses, but what businesses do you think are going to struggle more in this environment, and why?
I think banks could struggle a little bit.
Do you think banks, financials all together, or just banks in general?
I think banks in general, banks that have larger trading departments or asset management departments or other types of companies that like insurance companies, I think they're different from banks. But I think banks themselves, may have more of a problem in this kind of environment as their costs go up, as they also need to restrict maybe lending opportunities, and reevaluate also the massive amounts of underwater bonds that are holding back their ability to sell things to create new capital for opportunities.
What about the mid-level and regional banks? I mean, they've been struggling a little bit.
Yeah, I think they've been struggling because of asset allocation and asset liability decisions that they made when rates were abnormally low.
Exactly. I agree. Totally.
And the Fed did not forecast correctly what its plan was going to be. In fact, it told many of these banks, don't worry, you can buy things that have 1% or 0% interest rates and it will be okay. And then it wasn't okay. And it still isn't okay.
For our listeners out there, explain why higher rates specifically can expose weak operators in ways that low rates just simply don't.
Yeah, I think Warren Buffett said it best. You find out who's swimming naked when the tide rolls out. And
yeah, exactly.
And so once your variable rate interest rate or the loan that you got 5 years ago resets, and we're going to see a wave of resettings in 5-year loans that were done in 2021 and 2022 when interest rates were very low. We're going to see those start to reset here. And you're going to find out companies that, their rates on their loans are going to go up 400, 500 basis points, how they're going to be able to respond and how their lenders are going to be able to respond to that as well.
Let's talk about that. I think there's going to be significant consolidation across industries. Do you see that as well?
I don't know if there'll be considerable consolidation. I mean, I don't see a lot that will necessarily change with it. Like I said before, I think the economy is in decent shape, and a 4.5-5% base rate, added on 300 to 500 basis points on top of that. Most businesses can borrow at 8% and they can still do just fine. So I don't see that that's a real shift that's going to create a demand for consolidation, or that's going to make people do things differently. It may just temporarily reduce their profitability.
I hope you're right. My next question is about the environment. Does this environment favor experienced operators over younger, more aggressive ones?
I don't know on that one. I think that experience always matters, but an aggressive young entrepreneur with a good idea is usually hard to beat.
Well, when you think about businesses, what do you think separates a durable business from a fragile one in today's environment?
I think a durable business will have a plan going forward, and a customer base that is going to stick with them when they have to raise prices. I think that's part of what's going on here as well, which is that prices are going up. That in a world where structurally inflation is 3% or higher, your business is going to have to raise prices in order to raise wages for your employees and to buy the things that are inputs for what you're building for your customers. Everyone's prices are going up.
Yep.
We saw the producer price index is now almost 5%. That's going to get passed along to customers, and customers are going to have to pay it. And so the durability of your business will be directly related to whether you're able to pass on those costs to your customers.
Absolutely. And when you were talking about a plan, so when business owners are thinking about their plan, how do they think about debt today versus how they thought about it 5 years ago?
Yeah, I think debt when it's cheap is easy to say, hey, we can just finance this project, and interest rates will be zero forever and no problem. I think now it's a little more caution, but it's not necessarily more caution than they had, when interest rates were at this level, a decade ago, right? We went through this period where things got really, really crazy. And I think, we're getting back to sort of normal. And I hate to use that word normal, right?
No, I think it's a good word. I agree, because there was a period where growth was the strategy, right? It became the strategy. Is profitability, cash flow, and operational efficiency finally back in the driver's seat, in your opinion?
I mean, for me, cash flow has always been king. I mean, cash is the thing that gives you the most flexibility. We were talking in our .com podcast about my roommate and his burn rate. At that time, I was buying Philip Morris Altria. Why? Because I knew that they were going to sell a lot of cigarettes and cash flows were going to be there, and I didn't need to worry about whether what their burn rate was a huge positive, because as long as customers were burning cigarettes, they were making more money.
Different burn rate. Yeah, exactly. Yeah. So the investment side of this conversation is just as important, because easy money affected asset prices across the board, right? So stocks, bonds, commercial real estate, venture capital, almost every asset, kind of every class benefited from extremely low rates. Think about where we were. Some of the largest investment losses in history came from investing in real trends at irrational prices. The trend may be correct, timing and valuation may not be. So, Gary, how does a sustained higher rate environment change the investment landscape at a fundamental level?
I don't think it changes it at a fundamental level from here forward. I think it did change it dramatically when we went from 0 to 4 or 5%. But as long as we're in this era, I think that we are now reset to something that makes sense for an era where interest rates are going to be around this level. Plus or minus.
Okay.
And so I think we can just baseline it now that this is where we are, and this is what we should plan for, and this is what we should expect out of valuation. Yep.
Well, it sounds to me like you think that the valuations and the market's already priced this into the new reality. Is that what you're saying?
I think for the most part, 4%, 5% interest rates are priced into stock prices. We shouldn't expect anything particularly different, going forward. And also because interest rates are going up still, I think partially for the right reasons, that there is a tremendous amount of growth coming in the U.S. economy. It's not just all negative from inflation. It's also that we're seeing a lot of growth in the U.S., And so interest rates are going up both for, good reasons and for bad reasons. But it's not primarily just for one or the other.
Yeah, so I think that's breathing a little life in the bonds too, right? So how should investors be thinking about fixed income right now?
I still think investors should be, relatively short duration. Like I said, there's upside risk to rates on the long end of the curve. In tactical places, I think that what we've also seen is that, with the war in Iran, we've seen first central banks selling gold to defend their currencies and to buy energy and other commodities in their countries. And then secondly, started to sell U.S. treasuries to defend their currencies. And so I think that has been part of the rate story on the long end of the curve here recently, in addition to the underlying inflation story, but they're both connected. But I think that, ultimately, I think, we're at a relatively fair price here for the U.S. 10-year at 4.5%, but I don't find it particularly attractive just because it's a fair price. I'm looking for fair prices in stocks. I want to get a real deal if I'm going out 10 years to buy a bond, and so I just don't think that we're being compensated for the risk that we're taking. A 10-year risk ought to carry more return than that.
You know how I feel about bonds anyway, but one of the things I'm seeing investors, you're hearing it more, actually seeing it more, you're reading about it more, they're buying on the dip. So that, to me, that conditioning is dangerous in this environment. Do you agree with that? And if so, why?
It seems like buying on the dip has been a good strategy. Dips have been fewer and further between. We've only really gotten, one sizable dip per year the last 2 years. And so, in a bull market, one of the conditions tends to be that, every day or so you make a new all-time high. And, I like to think about it in terms of maybe in the 1980s, you couldn't, if you were always scared that you're buying stocks at an all-time high, well, then you missed out on the next day, which was an all-time high too. Because if you're at an all-time high, anytime the market goes up, you're at another all-time high. So being afraid to buy stocks just because they're at an all-time high doesn't make a whole lot of sense to me.
Yep, I agree. And I think what I've seen also is that passive investing behavior is not really the type of environment compared to what investors experienced over the last decade, right? So what would be your rule of thumb? I don't believe investing in dips. I don't believe in being passive, so my question to you are, what are the market concerns you have most right now?
The market concerns I have most right now are related to the war in Iran and what's really going to happen there. If we get a scenario where we sort of walk away and oil and energy commodities and other things are 20 to 25% higher, then I think that's going to be tough for the non-technology sectors of the market. It may impact the technology sector a little bit on the margins, but I think markets investors right now are poised to sort of look through that. But for other companies, that are more traditional and not being thought of as technology companies, I think that environment where their costs are going up, maybe they can't pass it on to consumers quite as much, they're getting squeezed. I think that's going to be problematic for them. And so, as I think about the market as a whole, there's a whole slew of companies that are not in the technology sector, and so those are the ones that could get squeezed, with higher interest rates and with lower profitability. That's a bad situation to be in.
What do you actually see opportunity, or where do you see that the market may not be fully appreciating it yet? Like right around the corner, maybe. If things go the way you want them to go, that may be something people aren't really looking at or can appreciate right now.
Wade, I think that maybe tips are an area that are potentially interesting.
Okay.
I don't really see a whole lot of areas that are unexposed right now to trends that are continuing. It's kind of a boring answer, but unfortunately, I think that's our answer right now. That I don't see anything that isn't already sort of in play.
Okay.
Presenting massive value that I can see right now.
Okay, so we talked about in a show not too long ago, international markets, right? So how do you feel about international markets? Do they benefit more in this environment relative to the U.S. markets where we're at with all-time highs?
Yeah, I think that is an area where we're probably going to want to dip our toes back in, when and if the war ends. That the trends that happened during the war of the dollar going up and the U.S. markets,
Right.
sucking all the capital in with dollar assets is probably going to flow back the other direction. And so yes,
I gotcha.
I think that's where we want to buy international. And again, international related to commodities, international related to technology are going to be our sectors where we want to be the most.
I totally agree. Totally agree with you. But throw a curveball here. What do you think happens to portfolios that are not prepared if rates stay elevated for years rather than just months?
A portfolio that is not positioned this way will see their bond portfolio become a liability rather than an asset. That it will become a source for perpetual losses rather than for income that they can depend on, and also assets that they can need for liquidity. It will be a loss generating machine if they're not careful.
I totally agree. I totally agree. So I also think there's a psychological adjustment happening that we don't talk about enough. You think about people become unaccustomed to ultra low mortgage rates, rapidly rising asset prices, abundant liquidity, and the idea that central banks could always step in and rescue markets quickly. That mindset shaped behavior in ways that are going to take some time to unwind. Gary, do you think investors will expect the Federal Reserve to rescue markets when things get difficult? And is that expectation realistic moving forward?
I think a lot of investors live in a world where they think that the Federal Reserve has to rescue investors, that the world is so dependent, or U.S. investors and their 401ks are so dependent on those stock prices continuing to go up and being maintained, that the Federal Reserve will have to step in to provide liquidity to markets to prevent stocks from going down.
Yep.
I think that is a folly. While it has happened quite a bit and quite a bit more than I would want it to, I don't think that we can depend on that anymore, or that we should depend on that and people who are, I think, are taking a much bigger risk than they think they are.
Yeah. So we know consumers are beginning to feel, pressure, higher capital costs in their daily lives. And what does that mean for spending in the broader economy around the corner?
So far we have seen the consumer be relatively resilient. They are choosing wisely, as we would expect. They're substituting, chicken for beef. As beef prices have gone up, they're looking to shop more at stores that provide excellent value, and And I think that even wealthy consumers now are in that boat. You've seen a trend where wealthier investors or wealthier people are shopping at dollar stores or shopping at Walmart. And so I think the inflation has become psychological to a very, very important degree.
Yeah.
And whether it's actually pinching pennies of consumers are acting as if it has. And I think we've seen that with real wages not increasing faster than inflation for some period of time here, and the consumer falling behind. And I think that's a real issue.
I do too. And you mentioned, psychologically, and I'm not asking you to be a PhD in this, but how long does it take investors and business owners to adapt, in your opinion, fundamentally to different economic eras, right? So how long does that shift typically take, in your opinion?
I think, I'm not a PhD psychologist, and I guess I'm going to play one on this podcast right now. But I think people...
well, you've got a little experience, Gary. Just, you've been around a while now.
Okay. So from a market's perspective, people keep doing the same thing over and over and over again until it really bites them hard. It takes a crisis to change somebody's mindset. And so I think I think it's going to take a real reset of expectations from some massive market move to shake people from this idea that they're getting entrenched in, which is inflation is a problem. I need to act as though inflation is a problem. And that's something that we didn't have in this country for, the better part of 20 years or so. Right. And I think now we're getting dangerously close to, what people felt like in the late 60s and through the 1970s and into the early 80s, worried about inflation. And so I think that's something that is going to stick with us.
So your honest assessment at this point, are people really prepared? Or are they still operating the assumption of the last decade right now? No,
I think people are prepared. And their base case scenario now is that inflation is here with me. And, what does that do? Well, it increases consumption in the near term because you say, well, if I don't buy this today, tomorrow it's going to be more expensive. And so, we're seeing people make purchases today that maybe they would have put off. They're not saving as much. They're consuming because they think that the thing that they're going to consume is going to be more expensive tomorrow. And so that can have serious capital allocation issues in the broader economy if people reduce their savings rates and then are not prepared from a savings perspective for when those savings are needed.
Yeah, when life happens. Yep. All right, so Gary, let's bring this home. We've covered what created this environment and what it means for business operators, what it means for investors, what it means psychologically for the people living through it. And as you know, I always close with 3 questions. Given the weight of everything that we've discussed today, I think these are going to be pretty difficult versions again. So the first question for you is, what's the single most important thing that matters right now for investors or anyone navigating this new economic environment?
The single most important thing is to put away this notion that rates are ever going to be 0% ever again in your lifetime. I think that is a fair thing to say, that rates are never going to be as low as they were a couple of years ago, and you should expect that rates if anything, will be higher.
I agree. Very good. What are you watching over the next 6 to 12 months that every person in the audience should be paying close attention to?
I'm going to be watching the Federal Reserve like a hawk, and expecting them to trying to figure out whether they're going to be hawkish or dovish. But I'm going to be watching them like a hawk, and reading the tea leaves as much as we possibly can.
So if they announce their expected lifetime inflation rate, are you going to give up on them?
If they continue to talk about 2% like it's a real objective, I think they lose credibility every time they say it.
Yeah, I would agree. All right. And finally, what do investors and business owners absolutely need to avoid right now?
The trap of dipping into savings for things that aren't necessary. I think the idea of going to quick consumption or making investments now at the expense of their nest egg is something that they need to be careful about. And frankly, it's a great reminder of the value of a terrific financial planner to keep you in shape for thinking about what the size of that nest egg should be, and to also make sure that nest egg is invested appropriately, which is something that we do here at Concord very effectively.
I think the biggest takeaway today is this. The economic environment is shifting back towards something more historically normal, even if it feels unfamiliar after the last decade and a half. That's not necessarily bad news, it's just a recalibration. In periods like this, the businesses and investors who thrive are not necessarily the ones with the most capital or the highest risk tolerance. They're the ones with strong balance sheets, honest cash flow, operational discipline, and the patience to make long-term decisions without being rattled by short-term noise. Cheap money rewards speculation. More expensive money rewards discipline. And if you're building something you want to last for your family, your business, or the community you live in and serve, discipline is always the answer. Gary, great discussion as always, and that is exactly why we call this Built to Last. See you next time.
This podcast is produced by Concord Wealth Partners, LLC, an investment advisor registered with the Securities and Exchange Commission. Registration does not imply a certain level of skill or training. The information presented is for educational and informational purposes only and should not be construed as personalized investment, financial, tax, or legal advice. Nothing discussed should be considered a solicitation or offer to buy or sell any security or investment product. All investing involves risk, including the potential loss of principal. Past performance is not a guarantee of future results. Individual results will vary based on personal financial circumstances, risk tolerance, and other factors. Concord Wealth Partners does not provide tax or accounting services. Tax and accounting services are offered through Concord Business and Tax Advisory, an affiliated CPA firm. For more information about Concord Wealth Partners, including our Form ADV Part 2A and Form CRS, please visit concordwealthpartners.com or contact us at 800-838-4370.